Welcome to the Aramir Roundtable. I'm Tom Nunemaker with, I guess, Ed from Random Walk. Ed and I go back a long way from the old Sheridan days, so it's nice to have you back, Ed.
Thank you.
And before we get started, I just have a little disclosure. Aramir Corporation is not a broker-dealer or investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. We're not making any specific trade recommendations. Past performance is not indicative of future results, and hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that, Ed, I'll turn it over to you. I'll still be here, but I'll just mute my microphone so I don't have any background noises interrupting you. But if I see something in the chat that you need to see, if you don't pick up on it, I'll bring it to your attention.
Okay, sure.
All right.
All right. Thank you, Tom, and let's get the slides going here. So we got our normal disclaimer here, so we'll just use yours.
Okay.
Educational purposes only, as we like to say. And then I'm assuming this will be recorded and be put in your archives.
Yeah, and if you want to, just send me the slides and I'll attach them to the recording.
Okay, sure. I can do that.
Great.
So pregnant butterflies. So we're probably going to do an overview. There's a lot of moving parts to this. Just to some background, I've been playing with this for the last 6-7 months, but recently for our trading group, it's probably in the last month or so, kind of rolling out what we're trying to do and stuff. And students seem to be liking it, but kind of go over what the purpose of the pregnant butterfly is, a quick review, some butterfly types, the factors that come into play, pay yourself first, which we'll talk about. And then of course you got any questions, go ahead and type it in the question box there and we'll get to it. But what's the purpose of a pregnant butterfly? We're using a pregnant butterfly mainly to play direction. So it's kind of a directional type butterfly. And the motivation is to get our monies back. So whether you pay $1, $2, whatever you pay for that butterfly, we're looking to get that money back as soon as possible without inducing a huge margin or larger risk. So I can get my money back real quick and do a 50-point wide credit spread or something to pay for it, but we'd like to try to do that without margin, or get a riskless, but get all the play with house monies as quickly as possible. The strategy kind of centers between 20 and 35 days. And of course, from a cost standpoint, when you're doing any type of butterfly type trade, it could be a straight debit type trade. It could be a credit if you're doing like a broken wing butterfly, put broken wing butterfly. And sometimes you got a margin along with a combo. So as far as, like butterflies in general, if you're going to buy a butterfly, you can put it on for a debit, you can put it on for a credit. If you're putting it on for a credit, you're typically going to have some margin involved. And typically the larger the credit, the larger the margin, just a general rule of thumb. Now we're dealing with very short-term options. So we're trying to keep things pretty, kind of playing with garbage options typically, but we're looking for is try to get some good risk rewards out of the trades. So let's So some of the butterfly cousins or types, there are many, many acronyms for butterfly styles. This is not a total list of all the different butterflies. Standard butterflies is, symmetrical butterflies that you kind of learn in, options 101. Broken wing butterflies, the outer wing is typically pulled out a little bit further than the other debit side of the butterfly. 132 butterflies, you have typically twice as many shorts than long debits or long verticals in your butterfly. Stack butterflies is something that I kind of was using this past summer, and we use that in some of our strategies to increase the profit zone and kind of double the profit area, which is kind of nice. Venus butterfly is what we'll be talking about because that's kind of the premise. It's a little bit more of a directional type butterfly because we're lifting the outer wing versus pulling it down. We're lifting it up, so it's a little bit more directional type butterfly. And now we're throwing in the mix these pregnant butterflies. And I'll talk about, why is it a pregnant butterfly? It'll make more sense probably as we kind of go through it. But again, what we're trying to do is to find a way to pay for the initial butterfly and then play with this house monies and kind of rinse and repeat. So let's... So some of the factors that kind of play into the decision-making process is obviously the days to expiration. Generally 20 to 30 days to expiration. I said 35 on the previous slide. Again, these are just guidelines. It's a kind of a fluid strategy that will get refined, and I'll update the dashboard product that we got, which you'll see here in a little bit as well. Higher implied volatility typically will go out a little extra time, and as far as extra week or so when we get higher implied volatilities. Lower implied volatilities, we might go shorter in duration, just to take advantage a little bit of volatility. But volatility will, is going to disintegrate once you get to day 1, day 2 of your trade, and get into your gamma situation where you're trying to balance your theta and gamma ratio type of things. But generally, we're using these trades to kind of just like I said, 30 days or under, and take advantage of some of the outside edges of the normal distribution curve, and see if we can pack in some profits. As far as underlying, I like to focus on the SPX because it's pretty liquid. It's got 5-point strikes, many expirations. You got Monday expirations, you got Wednesday expirations, you got Friday, you got quarterlies, you got monthlies. You even got the minis in there. I'm not a fan of the minis, but and you can use some of the highly liquid stocks as well. Your Amazons, your Apples, Facebook, Tesla. But the SPX is cash settled, which is kind of nice. And you don't have to worry about in the money options because you're going to be cash settled. So that's a plus. So delta on probabilities, just like instrument gauges on your car's dashboard, deltas and probabilities play a role in our selection of what butterfly we were going to start with, along with our plan A, plan B, and plan C. And then a balance between cheap and higher probability strikes to build our butterfly. So when we look at delta, we know that many times people like to sell 30 delta options. Nothing wrong with that. And then you go out to your 1 standard deviation. You're looking at your 16 deltas, and then you build a condor, build a butterfly, or something around it. So what we're trying to do is to find, obviously, the closer we get to at the money, it's a higher probability trade. It's going to cost more capital. And we're trying to balance that as far as the monies that we can receive to pay for the initial butterfly. And what I'm calling this plan A, plan B, and plan C scenario. So think of a, whatever butterfly that you put on, you pick whatever it is. It's sort of like a chess game. You got a plan A, a plan B, and a plan C scenario to find a way to get your monies back for that initial butterfly. It could be verticals, it could be another butterfly, it could be a credit spread, all that type of thing. But what we're going to do is to look at what type of spreads that we can do, whether it be 5, 10s, like I say, broken wings, and play with the expected moves and see if we can get the initial money back for the butterfly that we put on initially, which is the Venus butterfly that we kind of start the whole trade with. So the other big factor is the expected move. And there's formulas that you can use. You can use the toss, you can use the at the money implied volatility, and multiply by the stock price, times the days to expiration divided by 252, take the square root of that, calculate your expected move. And generally we have a general idea of what strikes we want to build our butterfly. But the second litmus test, so to speak, is we want to take in consideration the expected move on the plan A, plan B, and plan C trades that we might be looking at, and seeing if that will pull in enough credit to pay for our initial butterfly. Because in a Venus butterfly scenario, those are all typically debit spreads, but there's no margin. It's not a broken wing where you got margin on it. So we're starting with a pure debit type trade. So that debit trade, your max loss is whatever you pay for it. So if I pay $1 for a butterfly and buy 5 contracts, I got $500 at risk if it decides to sit there and expire worthless outside and not in the butterfly. And with that expected move calculation, we'll take that to pick the initial strike selection for the butterfly. And again, we're looking for a good risk reward ratio and seeing if, based upon the expected move, we can get the price that we like for the butterfly, and also the impact as far as our plan A, plan B, and plan C to get monies to pay for the initial trade. Because if I can get plan A, plan B, or plan C to execute, I'm looking to lock in some profits with that first layer or first adjustment type of thing. So for example, if I pay, like I said, $1 for a butterfly and I sell a vertical, I'm going to try to sell within the butterfly if I can, and collect $2. And if I collect $2 and paid $1, I've locked in $1 profit essentially. Now, of course, the magic question is we need the expected move to happen. Doesn't always happen, but we're playing the probabilities to our favor and see if we can get something to work. And we'll look at an example of that just to make sense. But like I said, it's a lot of moving pieces to this kind of strategy that we're trying to do here, but it's kind of fun at the same time. So getting started, the then and what. So after we get the initial fill, which is typically that Venus butterfly, which we'll look at, we're looking at ways to get our monies back plus a small profit. So again, if I buy $1 butterfly, and if I'm going to sell a vertical with inside the butterfly, I'm going to sell it at least for $1.25, $1.50. So that first vertical or whatever plan A, plan B, or plan C is going to help pay for the initial debit. And now I got initial credit on, so everything, your P&L is essentially above zero. Whatever the credit is above your initial debit. So again, if I pay $1 and I collect $1.50, I get 50 cents kind of locked in per contract. And then once we kind of play with which butterfly we want, and then looking at our plan B, plan C's, which are just again the simple verticals, another butterfly. Again, we'll look at it here in a second. We got to we can plan for picking the initial strikes as far as what butterfly we want to use. And we've already kind of vetted out the additional layer trades or adjustments to lock in profits based upon the expected move for each of them. And this is what we kind of balances the cost of plan A, plan B, plan C, along with the probability. Because yeah, you can pick a good butterfly, but if any of your plan A, plan B, or plan C, your 3 adjustments per se, doesn't pull enough credit, you could potentially lose money if it doesn't land inside the butterfly. And what we're trying to do is to get our money back as quickly as possible. And roughly 2 to 4 days max is what we're trying to shoot for. So like I said, once we got a general idea of what that initial butterfly is, and we've picked out a plan A, plan B, plan C, we're going to use that expected move. And let's say expected move, the S&P, a lot of you guys trade S&P or Russell, but S&P, SPX, it's like anywhere from 25 to 50 points expected move. If I'm looking at the average true range, 5-day average true range. That doesn't happen every day. Obviously some days they're kind of quiet, other days we're kind of moving around pretty good. And let's just say for conversation's sake here that the SPX moves 50 points a day. With that expected move, I can go up and down the option chain to figure out the price of the butterfly, the vertical, broken wing, what have you. But I can be conservative and just use half that amount to kind of shifting levers, so to speak, to figure out what the price of each of those components would be. And then I can then go Christmas shopping when the market is open. I got a rough idea what spreads I'm looking at. I know roughly the price that they can go for. And then kind of put a plan together. Again, we got plan A, plan B, plan C. And all those plans are basically to pay for that initial debit for the Venus butterfly, because that's going to be a debit type cost. And that's generally between $1 and $2, roughly. And then once we kind of get plan A, plan B, or plan C, or maybe a combination of those filled, then we can kind of rinse and repeat, go to next expiration. Or maybe you want to do, we call layer spreads. We can add stacked butterflies to it. But again, it's just to try to take advantage of some of the sudden moves in the marketplace. And again, we'll do a little example here to kind of give you a flavor of what we're trying to talk about here. So this little busy Excel chart, let's see. So what we got, this is looking at the SPX option chain for December 24th, day before Christmas. So we got a little over 27 days roughly to Christmas or something like that. And this is based on last night's around 2680 in the SPX. Calculate the expected move for the calls around 150 points, which would be about 28.28. And I also did it on the put side. But what we got basically here is the strikes of the SPX. And I'm looking mainly at the puts here for a second. So this is the delta of the puts. And then we got the price of the puts. And then the Venus fly is a 25 by 20 put butterfly and the cost of what that is. So for example, this 2620 Venus fly is basically going for $2. And then next to it, I kind of put the price of a 5-point vertical. And then next to it, I put a price of a 10-point vertical. So I can see I could spend $2 for a Venus fly, and then I could, I got a 5-point vertical that I could sell, like a 10-point that I could sell. And then I want to see what these three components will, as their price moves up and down, because we use an example of 50 points in the SPX. I can be conservative and say, I just want to go plus or minus, instead of 50, I want to go plus or minus 25, a little bit more conservative play. And I can go up and down this column to figure out what the price of the butterfly would be. So for example, if we had a 25-point move in the SPX, and it's trading at $2 and the market rallies, I can go up 5 rows, and this $2 would become 1, 2, 3, 4, 5, would become roughly $1.45. So remember, a put butterfly at $2, the market rallies, you're going to lose money on that put butterfly. It's going against you. So I'm taking that in consideration as a best case scenario, because we want to try to get the butterfly as cheaply as possible. So we need a little bit of help from the market. I don't like to chase the fills. If it doesn't happen, then I'll just reshuffle and play the deck for tomorrow. So I could do the same thing with a 5-point vertical. Again, I'll just stay in the same $2 row here. This is a 5-point vertical. The 2615, 2610 verticals is $1.20, roughly $1.20 credit because we're selling it. My risk is the width of the strikes minus your credit. So in a 5-point spread, minus $1.20, $3.80 risk per contract. But again, I can use that expected move calculation, and if the market rallies, and we go up, this put spread that I'm selling it can decrease, and you make money. 1, 2, 3, 4, 5 becomes 90 cents. So you can sell for $1.25. Market rallies, becomes 90 cents. You can lock in your 25 or 35-cent profit. But in a pregnant butterfly situation, what we're looking to do is to sell something a little bit in, maybe 5 points in. And if the market, so let's pretend for a second the market rallies today, the $2 butterfly we get filled at $1.50. So that helped because we used half the expected move. If the market rallies, that's the best case scenario for this butterfly. Now, in the best case scenario for selling a put spread, $1.20, and the market goes down, which is good because we're trying to collect some premium, I could go the opposite direction. And if, let's say the market goes down 25 points, I can just go down the options, this column here, 1, 2, 3, 4, 5. It goes from $1.25 to about $1.50. So I collected an extra 25 cents when the market went down. So I can get a rough idea of what this particular spread if the market goes down, obviously we got delta that's going to increase the price of that put spread. IV will go up a little bit, so it might be a little bit higher. I could do the same type of scenario on a 10-point vertical. I can go up and down the option chain to figure out what the price of that 10-point spread is going to do based upon an expected move. Now, what I got over here is basically kind of a cross grain putting in the expected move for you. So this $2 spread, and if we go the expected move, becomes $1. So this is roughly 14. Let's see, it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So a 14-point move, which is, I think what's the spreadsheet's calculating for you. So you don't even have to go up and down the option chain. You just go from this column to this column to get the price of what that Venus butterfly would become. So again, a $2 butterfly could become $1. And you can say, okay, I'm paying less credit. The market's running away from me. And the market rallies by that expected move, which is half the expected move. I'm not using the full position. I could buy twice as many of them if I'd like. Or if you want to get closer at the money, you can do that as well. But we're just going to keep it at $1. Keep it simple. So if we get filled, let's say at $1, and then I could see the price of the 5-point spreads are anywhere from $1.15 to $2.10 that I'm looking to inject into the butterflies. That's where the pregnant piece comes into. And we got a risk graph for, to make a little bit more sense here in a second. So I can see what the price of my 5-point spreads are going for. I can see the price of the 10-point spreads. Obviously, the 10-point spreads will induce some margin into the trade. 5-point spreads, we try not to do that if we can. If we can get filled on the 5-point spread, then we will not have any margin, and we'll actually have credit in the trade, which you'll see in a little bit is here as well. But I think the example I did today was we got filled on a 10-point. And basically what we do is just set it up as an OCO order between a 5 and a 10-point. And whoever gets there first, we really don't care. And we just want to get filled on the initial debit of the trade. Now, the other scenario, we're talking about a put butterfly. If you're doing a put butterfly, bearish, obviously type trade, the market could rally. The market could rally, 200 points. Some Trump Twitter feed comes in, or some kind of trade thing comes in from China. Market rallies 200-300 points. And that's bad because we paid $1 or $2, whatever you're paying for your butterfly, you're going to be out the money. Well, plan C is what we say is a call broken wing butterfly. So I can sit up here and look at this 2730 5x10 broken wing butterfly. It's currently at $1.30. But if the market rallies 50 points, that will become from anywhere from $1.30. It will become $2.60, which is fine because if I'm paying $1 or $2 for the butterfly, I can get my money back. But I'm still going to stick with this butterfly. But I want this credit. I don't want to get, because you can get your face ripped off if the market rallies. But again, I'm looking at the expected move of each of these components. So we got 5-point verticals, we got 10-point verticals, we got the Venus put fly, call broken wing butterfly. But this credit is to help offset the cost of the put side. And I'm waiting here. So I'm sitting in the ditch, so to speak, here for this broken wing butterfly at 2730, currently at $1.30, but I could put an order in for $2.60 or even $3. That way I'll get credit in, pays for my initial butterfly, and obviously the more credit I get on this call broken wing butterfly, it's going to reduce the upside margin, because a broken wing butterfly will have margin. So again, plan A, plan B, plan C. So a lot of different little components, and it's a lot to cover in a short amount of time. But that's kind of this is a live dashboard sheet that we use as the Excel dashboard product that we have. And this is going to be a new revision, obviously, because it's only 3 weeks old. So it's in its baby infant stage, so gave birth. So here's a recent example we did in class. This is a December 10th expiration. So 2655, 2630, 2610 put butterfly. Got filled for a $2 debit. I want to say it was like $3 or $3.50 when we initially looked at it. Market rallied and we got filled at $2. doing 5 contracts. So from a risk standpoint, that's $1,000 I'm putting at risk here. So if we sit here, I could lose $1,000. Obviously, we want to get something a little bit further downstream and get, hopefully at expiration have something inside the butterfly, and life will be good. So that was the initial trade that we kind of put on. So the next piece, we had an OCO order. We had a 5-point and a 10-point spread. The 10-point spread got filled. The market kind of rallied to the downside, and we sold a 10-point vertical and collected $4.50 out of it. Obviously, if I spend $1,000 on the first one and I sell 5 contracts at $4.50, that's $2,250 I collect, which gives me at least a min profit of $12.50 if we're above $26.15. And my max margin on the downside here is also $12.50. So if we get below $26.15, I do have risk, but I've locked in some profits here. I've paid for the initial trade. This is not our, this is, I think, our plan B scenario. Plan A would be our 5-point vertical. But we got filled, $4.50 credit, pays for the initial butterfly, which is what we want to do. Adds a little bit of downside margin, but we've locked in some profit, and then we got a lottery ticket essentially here between now and December 10th. So again, we're dealing with options less than 30 days out, and theta will start kicking in. We already got some positive theta, obviously at $25 per day, and obviously this will be you're going to max out at $12.50 here at expiration if we kind of sit above here, but we got a small little window for a little bit larger profit window. So on that big down day that we had, and we got filled on this put spread, I said, let's do the same thing on the upside. So everything that we just talked about for the downside, doing a Venus put butterfly on the downside, we can repeat that process and do it on the upside. So what I did here is just bought a Venus call fly, paid $1. The market was severely oversold, and paid $1. So I'm spending 5 contracts times $1. I'm spending $500, and so instead of $12.50 underneath the tent here, I got a minimum of $750 profit if we stay above $26.15 at expiration. Still got my downside margin. There's no margin on the upside. If the market decides it wants to rally, go for it. But I got orders in to sell, a 5-point or 10-point vertical. On the upside, obviously, it's going to be a little bit tougher to do because the skew of your call, the skew on the call side is definitely flatter than it is on the put side. So if you're doing, butterflies and stuff, you pay attention to the skew. You know that the skew is flatter on the calls than it is on the puts. So what we did is, like I said, when we kind of bottomed out here, we went ahead and bought the Venus call fly. Paid $500. If it rallies, then we get to participate versus just waiting for the downside. The market just kind of sits here. So we wanted something that we can do. Now, once we have this on, then we can treat this as what we call a layer trade, and we can add stacked butterflies and all kind of fun little stuff. And that's what we're kind of playing with in class with the students, and try to milk out some more profits. But again, we're just trying to take advantage of moves within the market and using a directional type butterfly. So a call fly, obviously this is a bullish type fly, and with a extreme oversold, whatever indicator, you're looking at squeeze, you're looking at moving averages, you're looking at stochastics, MACD, whatever, and you trigger it, find a butterfly that you want to put in, you get filled, and we're going to rinse and repeat. And what will happen is, is if we continue to go up, we can, sell, part of this, collect some more monies, turn it into an iron condor, all kind of different flavors, because we're always looking at, how do we take risk out of the trade? Because in this particular trade with the December 10th expiration, the shaded area here is our plus or minus 1 standard deviation. So the underlying can move around, plus or minus 1 standard deviation, which will be in there, 68.5% of the time. And this butterfly is obviously, I think we put that on last Tuesday, last Wednesday. and volatility has contracted a little bit and the market kind of slid down. So this is technically just outside the 1 standard deviation. And when we're looking to add something or another layer trade in here, if we can get something closer to at the money, it's a higher probability trade, because you could find a really cheap butterfly on the upside here, but it's a low probability trade setup because it's outside the 1 standard deviation. So the challenge that we look at is to figure out, how can we add something in here without injecting a lot of capital or a lot of margin, and kind of layer this up like a big old cake, or Italian wedding cake or something, whatever your favorite cake is. Might be like a dark chocolate gluten-free cake, but pound cake. But try to add something in here and try to keep playing this and watch the underlying kind of move back and forth. And then if we can take off profits, we'll take it off. But we'll play this typically to expiration. But this is what we had as of last night. So we're up $1,100 and a little over $1,500 in downside margin at this point. So just a simple, quick example. But I mean, again, it sounds complicated. There's a lot of moving pieces to it. Like I said, you got the initial Venus put fly that we start with, and then we got a plan A, plan B, plan C to try to get this monies back. This upside was really optional, but just for the students, it's like, hey, it's added in there. We've kind of played out the downside, and now we can play with the upside. So in summary, what we're trying to do with pregnant butterflies is to kind of play an underlying direction, and you got a bullish or bearish bias, and then immediately find ways to get our initial money back. Like I said, if you spend $1, $2 on a butterfly, we're looking to get not only the initial $1 or $2, but maybe 20% or 50% more of what you paid for it. And if you can, then you're playing with house monies after that point, because after you make that first adjustment or that first layer trade on top of your initial trade, we've kind of paid for the trade, and we're playing with house monies. We got a lottery ticket. It's not going to be the 40 billion or whatever it was, or the 40 million that we had a month or so ago. But we're looking to try to get the initial cost back and a small initial profit. Tack in your commission cost if you want. If you want to be more technical, perfectly fine. And like I said, we'd lock in a small gain. And after that first layer, that adjustment's executed, we're just playing with house monies, and then we kind of go to the next expiration. And with the SPX, like every 2 days or every, week, if you wanted to, you can start with a new expiration and just keep repeating the process. And one time you may have something that lands straight in the butterfly, take your profit and run, and then you can take a nice trip to Fiji or Hawaii or somewhere warm. I think it's 30 degrees here in North Carolina, so it's you may not want to come today. But anyway, that is just a quick summary of what this pregnant butterfly is. Basically, we're trying to put stick other verticals or inside the original butterfly to help pay for the initial trade setup. So, and just as a quick little promo thing is we got a combo package. We got a lot of good stuff on the website that we have. These are the 3 basic building block packages that students ask me about, or people ask me about. It's on the website. You can send me an email, call the office, call me, or send me an email. I'm happy to answer any questions. And then we do have twice a week. We do 2 webinars a week on Tuesday and Thursday nights. Thursday nights are specifically dedicated to this SPX weekly strategy. This pregnant butterfly thing's roughly about a month old. I've been doing it for over 6 months, but it's kind of rolling out to the students here. And we do offer SMS texts. So when trades filled, you can get a text message, got a chat room. And then I do a weekly write-up of all our open positions, about $60 a month. So, and that includes the SMS text messaging. But like I said, get any questions, give me a call, get in the office. But that's pretty much, I think, what I got. Yeah, that's all I got at this point. So,
well, I don't see any questions, Ed.
Mm-hmm.
Oh wait, there is one now. Do you see the chat?
Yeah. What do you do if you not get an opportunity to sell a credit spread after entering the initial butterfly? So Hans, we talked about what we're talking about was the 5 or 10 point put vertical that we're trying to sell. And obviously, if the market runs up, you're not going to be able to get filled on that credit spread, right? So that's where the call broken wing butterfly comes in, because that initial call broken wing butterfly you can typically put on for a credit. So if the market is going completely against you and zooming to the upside, a call broken wing butterfly that you initially look at, which in this example we saw $1.30, it's going to increase in price, and from $1.30 up to close to 250, 260. At 260, that's enough to pay for that $2 butterfly. So that's it's a very good question, and it's exactly why we like having that as a plan C scenario, because that's probably the worst case scenario. You're bearish and the market goes exactly the opposite direction. I mean, that happens. It happens to me a lot. You pick a direction and it's like, okay, we're not going down, we're going up. So hopefully that answers your question. So
I think Ted's asking about it looks like an Excel spreadsheet. Is that part of the $60 a month?
now it's a separate product. I think we got a promo on that. I'm not sure exactly what the cost is. Pretty economical. I think it's $100, $200. Don't quote me on that, but it's a live dashboard that feeds off of the TOS data stream. And there's a 2-hour video that comes with it that I go in pretty big depth, because any of those squares I showed on the Excel spreadsheet, you click on the $2 butterfly and you paste it in Excel. Paste it in TOS, and I paste it directly to the Analyze tab, so you don't even have to pick the strikes. It automatically knows the strikes and puts it in your TOS Analyze tab. So that's the beauty of it, and it saves a bunch of time.
That's pretty cool.
Mm-hmm. Yeah, because we start getting because I started, we talked about a put butterfly, and then we got two different spreads, a call, broken wing. It's like, holy cow, what strikes do I use? Well, I'm just using the spreadsheet. I can just click on the cell, go into TOS, paste it, and Analyze. I got it, and then I can do copy, send in the order, and then I'm good. So.
Yeah, I know at IB, it's I do a lot of manual stuff, so things like that to speed you up are definitely welcome.
Mm-hmm.
Oh, and then another question there.
Yes, is a purchase spreadsheet required to follow trades? No, you could do it manually. You can use TOS, and you just got to go into TOS and look at your option chain, and figure out what the price of the vertical is going to be when you go up and down the option chain. And you can do that in TOS. You pick vertical and look at your vertical price and just go up and down the option chain there in TOS and or the trade page. That does the same thing as the spreadsheet. Now my spreadsheet does get into some of these butterfly prices, make it a little bit easier for you. But you can get a rough rule of thumb with the regular butterflies and TOS just to kind of get you tweaked, because many times we might start with that and I throw it in the TOS Analyze, but we may tweak the strikes, maybe for margin or probability purposes. But at least get some clay on the wheel there, so you kind of mold it into whatever you want to form it in. But it's meant as a time saver for students, but you definitely don't need the spreadsheet. You can do it manually if you want. If you got some other method that you want to look at it. The key that we're looking at is to say whatever you're looking at, knowing what the price, how the expected move is going to affect the price of whatever you're looking at, whether it be a 5-point spread, 10-point spread, broken wing butterfly. If you know what that is, then you can go shopping and you know roughly what the cost of that's going to be. And then, we don't like paying retail for stuff. We like to get it on sale. So that's what we're trying to do. Is buy stuff on sale.
So do you ever have more than one of these pregnant butterflies on at a time, or is it just put it on and keep it on until it's closed and then do the next one?
We'll have multiple expirations. This is the first one we've done as a class, but I've done as many as 4 or 5 expirations.
So you'll have 4 or 5 open at one time?
Yeah.
Okay.
Because essentially, what I'm telling students is, once we get the risk out of a particular expiration, you're playing with house monies. let's just go into the next one because you have no margin tied up. Essentially, you may have a small amount. In this case, we have a small amount, but if you can get your risk off, and then you can go to the next expiration and kind of repeat that process, and then you can have different butterflies at different strikes.
Makes sense. Building a nice inventory.
Yep. And especially if you're just doing straight debits, if you're doing broken wings, you can tie up a big chunk of margin. Even Tasty Trade. I think Tasty Trade's come in with portfolio margining in January, so that's coming.
All right. Well, I don't see any more questions, so I guess we can wrap it up early. You don't need to keep people here if there's nothing more to say.
Yeah.
Any last points before we wrap it up, Ed?
No, I think it's going to be interesting to see what the market's going to do. I think that there'll be some kind of rally between now and Christmas. That's just my bias, but it looks like we're starting to enter into a more of a bearish market. Because as you know, the last 2 years, it was a slow grind to the upside. Every time the market kind of fell down, it kind of popped back up. I'm not seeing that bullishness here for the last since early 1st of October.
Yeah, it's basically been kind of drifting lower. A lot of volatility, but like you said, it's not really doing like a V bottom.
Yeah, and you just don't see that big thrush of volume kind of picking up the market. It's kind of meandering and just kind of petering out, and you get these really kind of weak moves to the upside. So
trades like this where you kind of limit your risk and try and do your best to take the risk off the table, these are good in these types of uncertain markets.
Yeah.
All right, Ed. Well, I guess that's it. Thanks again for coming. Have a great holiday season, and hopefully some people take you up on your offers.
Well, no problem. So enjoy.
All right. Thanks, everyone.
Okay. Thanks.
Bye.
Thanks.